You have a great idea. You have a product or service for which the world has been waiting. You've scraped together enough cash to get your idea off the ground. You have a location. You've done your advertising. You just know this is going to work. And 6 months later, you're out of business. Statistics from the Small Business Administration indicate that about half of new businesses fail in the first 5 years. Many new businesses fail, and the reasons are many and varied. In this course, we're going to address some of the primary financial reasons that new businesses don't make it. There are, of course, many non-financial reasons that new businesses struggle. Poor marketing, poor location, poor product quality. We're going to limit this course to the financial reasons for business failure. If you get everything right but the financial side of things, your business is going to struggle. Of course, if you get the financial side of things right and drop the ball with the non-financial aspects of the new business, you'll struggle as well. With this course, we'll stick with the financial aspects of struggling new businesses because that's what we know a little something about. We have identified 5 common reasons that new businesses that struggle seem to face. Of course, this is not an exhaustive list, but these 5 reasons seem to consistently pop up when it comes to new businesses that struggle. Those 5 reasons are insufficient capital, poor cash management, poor record keeping and controls, improper product pricing, and uncontrolled growth. Before we get started, let me first say that several of these reasons for struggling are interrelated. Uncontrolled growth can relate to poor cash management. Poor cash management can relate to poor record keeping, and so on. While these topics can be interrelated, we will address each one separately and then comment on the interrelationships when they are apparent. So, let's get started. Let's begin with the money needed to start a business. Too many new businesses start their business without enough capital. They just don't have enough money in the bank to support them while their cash flows get up to speed. It turns out that the rent has to be paid, the utilities have to be paid, equipment may need to be purchased or rented, the employees have to be paid, inventory has to be purchased. All of your expenses have to be paid while you're waiting for potential customers first to find you and then second to pay you. There's often a lag between when you get paid for providing a good or service and when you have to pay your vendors. And generally that lag is not in your favor. Also, when starting a business, it takes time for your customers to find you and for you to get your sales and marketing efforts up to full speed. During that time, your expenses will continue to need to be paid. It would be nice if all customers would pay immediately. It would also be nice if vendors would wait to be paid until you are paid. Yeah, that would be nice. Many businesses are forced to close before they are able to find out if their business model has a chance to demonstrate that it's sound. They just run out of money. When starting a business, realize that it will take time for cash inflows to start flowing, but the cash outflows start flowing immediately. Make sure that you have access to sufficient capital to allow your new business venture enough time to succeed. So how much cash is enough cash? The answer to that question can only come through a careful budgeting of cash inflows and cash outflows. It is critical that as part of your business plan, you sit down and carefully and realistically map out your expected cash inflows and outflows for at least the first 6 months of your new business. This exercise will allow you to determine any forecasted cash shortage and will allow you enough time to arrange for needed financing, either from partners or from creditors. Knowing well ahead of time that you will need cash allows you to make necessary arrangements for financing. Finding out today that you need cash tomorrow puts you in an unnecessary bind. We will talk a little later in the course about the specifics of cash management, but it is critical up front that you have an understanding that not having enough money to get started can result in a good idea meeting an early demise. Make sure you have sufficient capital or access to sufficient capital before you open the doors to your new business. Again, many new businesses with great business ideas don't make it through the critical first few months. A great idea is not sufficient. you need to ensure that you have access to enough capital to get you through those first few months. By the way, if you plan on going to a bank to ask for financing for your new business, one of the first things they will ask about is your cash forecast. They will want to know what capital you currently have available to you. If you plan on asking friends and family to invest, if they are smart, they will ask about your cash forecast. To obtain capital from others, you need a cash forecast. You might as well prepare one for yourself. The cash forecast will allow you to determine how much capital you will need to get you through those critical first few months. We know you'll need sufficient capital to get your new business through the critical first few months. Let's assume you've made it through those first few months. You will still need to track your cash inflows and outflows to ensure that you have sufficient cash to pay the bills that are surely coming. Whether you are at the start of your business or well into the life cycle of your business, managing cash is critical for the well-being of your business. And cash management does not happen by chance. It is up to you to ensure that your cash is managed. We will do this by preparing a cash forecast or budget. Let's start our discussion of cash management by distinguishing between two types of costs: fixed costs and variable costs. Fixed costs are exactly that. They're fixed. Budgeting for fixed costs is relatively straightforward. The amount is fixed, at least over the short term. Variable costs are costs that vary relative to some activity or cost driver. For a restaurant, for example, costs might vary based on the number of customers. For a shop at the mall, costs may vary based on the number of hours that the shop is opened, labor costs, utility costs, and so forth. Now, there can be a number of cost drivers, or in other words, costs can vary for a number of reasons. It just depends on how complicated you want to get. Adding more drivers makes the arithmetic a little more complex, but the concept is still the same. Now, step one in cash management is to identify all of your fixed and all of your variable costs, all of those costs. It's easy to forget an expense here or an expense there, and before you know it, your cash forecasts are useless. The cash forecast is only as good as the inputs. Next, we'll talk about variable costs. Answering the question, how many customers can we expect, is the hard part. Please don't gloss over this question. Your business will fail or succeed based on the answer to this question. How many customers can you realistically expect? Many costs will vary based on anticipated customer demand. Answering this big question is beyond the scope of this video, but it would involve such things as scoping out your competitors' volume of business, assessing expected population growth in your area, surveying potential customers, and a whole host of things. Your forecast of sales will be critical in helping to prepare your forecast of cash inflows and outflows. We will do some sensitivity analysis with these numbers to determine what might happen to our profits if more or fewer customers show up. Now that we have a reliable forecast of our cost driver, at least as reliable as possible, we can now compute our variable costs. Please note that as our business grows and matures, we will be able to determine a much more reliable estimate on the number of customers we can expect. Let's now turn our attention to the next area where new business owners tend to drop the ball. That is the area of poor record keeping. Most new business owners hate to worry about the record keeping. They would rather worry about customers and sales and innovation and growth and everything other than record keeping. Proper record keeping and internal controls are the blocking and tackling of new businesses. Not very glamorous and not very interesting, but it needs to be done. And it's safe to say that it needs to be done well. You can liken proper record keeping and adequate internal controls to the keeping of statistics in a football game. The person tracking the statistics is not on the field playing the game, but those statistics are very helpful to those who are on the field playing the game. As we discussed in the previous video on cash management, you need to track your inflows and outflows of cash so that you can forecast future cash flows. All we're talking about here is developing a system of tracking your inflows and outflows, your obligations to others, and others' obligations to you. It can be as simple as that. Depending on the size of your business, you can purchase accounting software off the shelf. There are a number of great products that will do the job with minimal training, but it is critical that someone take responsibility for keeping the books. Why is it critical? Well, 3 reasons off the top of my head. First, more accurate information about your business will assist you in running your business better. You will need information about cash inflows and outflows and about who you owe and who owes you. Second, if you ever need external financing, bankers or investors will insist on accurate financial information. They will need that information to assess business risk. You need that same information for that same reason. And third, taxes. Payroll taxes, property taxes, income taxes, the list goes on and on. You need a system that tracks your tax obligations to ensure that you pay the right amounts at the right times. If the government has to come in and do your taxes for you via an audit, remember, they don't work for you. They work for the taxing authorities. They will not be looking out for your best interest. That will not be their job. So, get yourself a system for tracking your inflows and outflows. Get a system that will keep track of who you owe and who owes you. Get yourself a system that will provide you with the information that you will need to better run your business. Now about controls. What are they? Controls are procedures that should be in place to ensure that 1. The information that is being collected in your accounting system is accurate and reliable, thereby helping you to run your business better, and 2. To safeguard your assets and your records. Now, what sort of control should I have on information that I will collect? You will need to answer questions like, how will you document that your cash outflows are legitimate business expenses? You better have proper documentation. If I'm in a business that has inventory for resale, how will I know how much I have on hand? How do I know how many hours my employees have worked? You better have a system for tracking this information. And of course, you will need a system that collects information about your cash inflows and your cash outflows. And you also need to know who you owe and who owes you. We've talked about that. What else? Well, you'll have information that's confidential about employees, pay rates, social security numbers, etc. That all has to be safeguarded. What about customer lists? What about pricing information? As you can imagine, there's a lot of top secret information relating to the inner workings of your business that you don't want getting out. You need to ensure that you have systems that protect your information and ensures that the system producing your information is accurate and reliable. One last thing to mention that is often taken for granted. You will need to safeguard your cash. You will need procedures in place to make sure that cash and checks are quickly and correctly deposited in the bank and that only authorized expenditures are made. This is no fun to talk about, but we tend to assume that those with whom we work are looking out for the best interest of the company. Now, that is often the case, but is also often not the case. Many individuals are looking out for them. You need to make sure that those individuals are never given the opportunity to be exposed to a situation where they might compromise their integrity. That is done by developing a set of controls within your business to ensure that information is collected quickly and correctly, and that procedures are in place to ensure that assets, especially cash, are handled properly. Now remember, we said at the outset that this topic is the no fun part of business. No one likes to talk about paperwork. If you don't talk about and establish a system that collects accurate information in a timely fashion and safeguards your assets, you will have plenty time to talk about that topic later when your business folds up. A good system of record-keeping and controls is what the scientists would call a necessary but not sufficient condition. A good information system will not ensure the success of your business, but a bad information system will certainly contribute to your lack of success. So what can be so hard about pricing a product? Don't you just figure out what your costs are and then add some sort of markup for profit? Oh, that it were that easy. If your price is too high, regardless of your costs, someone in the market will underprice you, assuming that the quality of product or service is similar. In many cases, you will be a price taker, and you will have to manage your costs so that you can earn a profit given a certain price is determined by the market. Now, let me say that again. In most instances, You don't price your product to cover your costs. Instead, you determine if, given a certain market price, your cost structure is such that you can earn a profit. The biggest mistake new business owners make in product pricing is not considering and covering all of their costs when entering a market. Now, it is true that when you are initially trying to penetrate a market, you may be willing to lose a little money to gain market share, but that strategy is not sustainable over time. Over the long term, you must cover all of your costs. All of your costs. Now to our last topic, uncontrolled growth. Growth is awesome. Increased market share is good. Sales trending upward is the dream. And unmanaged growth has killed a lot of companies. Growth must be carefully done or it could be fatal to your business. The reason being is that growth often requires cash, and cash is often the one thing that new businesses do not have a lot of. In fact, a lot of new business owners, when faced with the cash flow issues associated with starting a new business, they mistakenly think that the solution to their cash flow problems is to grow faster, not realizing that the fast growth is causing the cash flow problem in the first place. In other words, they hit the gas when they should hit the brake. So how does growth cause cash flow problems? Well, think about it. In a typical business that is selling a product to a customer on credit, that is, the customer will pay in, say, 30 days, you as the business owner need to pay your rent, pay your insurance, pay your employees, pay for the inventory, then sell that inventory and wait for 30 days to collect the cash. To grow faster means you need to buy and pay for more inventory and then sell that inventory and wait for 30 days to collect the cash. The more inventory you have to buy, the more inventory you have to pay for, and then still wait 30 days to collect the cash. Well, let's just have our suppliers wait longer to collect from us until we collect from our customers. Remember this, your suppliers are having the same cash flow issues that you are facing. They would like to receive their cash sooner rather than later. So what should you do next? That depends on what you identify as your particular small business problem. Are you having trouble with poor records? Are you finding your financial reports to be uninformative or too often non-existent? Then, like it or not, you need to learn something about accounting. Are you having trouble managing your cash flow? Are you always feeling cash squeezed with not enough financial capital to invest in the assets, information, and people that you need? Then you need to learn a little more about the field of finance. Maybe you feel like you are operating your business blind. Your profitability seems low, but you can't figure out why. Then you need some exposure to some simple techniques of financial analysis. Finally, remember that there are lots of qualified business advisors out there. Sometimes it makes some sense to spend a little money to meet with an experienced business advisor. Describe your business, your plans, and your frustrations to this outside advisor. She or he can then help you sort through the weaknesses of your business to identify the things that you need to work on first. Small businesses are the source of creativity in an economy. A small business is a precious thing, the embodiment of a person's ideas, energies, and ambitions. I salute those of you who have the entrepreneurial spirit and have started or are thinking of starting your own small business. I wish you great joy and success.